Welcome to Chapter 9, and in this chapter we are going to be looking at our costs and whether or not or how well we adhered to our budgeted costs. So we're going to come up with some standards for our cost: materials, labor, and overhead. And ideally we will hit those targets, but realistically we are unlikely to hit those targets. Now, these standard costs include things like how much a product should cost, how long does it take to make, what materials are included in those items. So those are all things that are determined when establishing the standard costs. Then we compare what the reality, what truly happened, with our original projections, and any difference between those is referred to as a variance. And we can either have a favorable or unfavorable variance. Now, the task of making these forecasts isn't just in the hands of the accountants. We want to include everybody who's involved in the production, because let's face it, how many accountants know how much time or labor hours it's going to take to manufacture a particular product? Probably not very many. You're going to need the folks on the front line to be providing that information to you, keeping in mind, of course, that there may be some self-interest there involved in that. So we may have the ideal standards. This is, in a perfect world, what everything should take. I mean, think about a commute, for example. The ideal standard doesn't involve any red lights, any accidents, road construction, all of those things. That would be the ideal. But as many of us know, you can't necessarily get in the car and not encounter some of those things. So then we have what are called really the normal standards. And it's, what we typically may be able to expect. It's not the ideal, best of all circumstances, but it's what's within reason. And we're, of course, going to always want to step back and can always reconsider whether or not the standards we've used are accurate, because just because we've established the standard doesn't mean it was correct, and doesn't mean we should stick to it if we've got evidence to suggest that our numbers are incorrect. And there are certainly some criticisms of using standard costs, because it would, if somebody may be motivated to hit their target, if they hit the standard, do they have an incentive to really improve beyond that? Unless you give them one, of course. So then do you have to continue to offer incentives to get people to become more efficient or more cost conscious, or whatever the case is? Your standards could become stale over time. So you've got to make sure that you go back and review those, and make sure that if there's new technology or other factors that have impacted the standards that you've used, that you make those changes. And you don't want people overly focused on hitting the standards to the exclusion of all else. I remember a number of years ago, Domino's Pizza used to advertise they guaranteed delivery in 30 minutes or less. And there was and now I think it's merely a suggestion. I don't remember. And if you do, shoot me an email. But there was an incident where a Domino's delivery driver was involved in an accident, and because if they gave away too many pizzas for free, that reflected poorly on the location or the delivery people or something. But he literally grabbed the pizza out of the car and ran from the accident scene down the street to where the pizza was supposed to be delivered. Now, there are all kinds of problems with that, but that's really a case at which their delivered 30 minutes or it's free standard started to run into problems. And even as I'm saying this, I know that that's a guideline that they have. And a neighbor of mine ordered, actually two neighbors on the same day, ordered a pizza from Domino's. And one of my neighbors shares my driveway, and this Domino's guy was blasting up the driveway really almost at highway speed and back down at about the same speed. And fortunately, I don't have pets or small children or anything I was worried about, but had I had pets or small children roaming about, I probably would have placed a call to the Domino's folks. And then I was walking around earlier or a little later down the street and saw the Domino's guy back again, similarly operating at a fairly high rate of speed on really a quiet residential road. So I suspect that somewhere there was some financial pressure for him to be meeting some sort of standard. So we're theoretically going to then look at our actual performance versus our predicted performance and evaluate how well we did. How well did we meet the standard price that we had projected, the standard quantity, that we had projected, and the budgetary performance evaluation is going to be based on standard price multiplied by standard quantity. And with that information, we're going to use the master budget, or prepare, I should say, the master budget for the sales and production that we talked about in the last lesson. So fast forward to the end of our accounting period. Now we're going to take a look back and we're going to compare our results to our predictions. In this case, the orange represents what we actually did. The blue is what we thought we would do. And you can see here that we actually did much better than we believed we would do. And in this case, we refer to this as a favorable cost variance. This isn't a volume. This is specifically a cost. This reflects cost. On the other hand, if we actually exceeded what we thought we would meet, we have an unfavorable cost variance. And so to the extent that you can commit those to memory, when we do better than we projected, that's favorable. When we do worse than we projected, that's unfavorable. We're then going to produce a report and probably use that report to evaluate our managers on that. So we will have ultimately a total manufacturing cost variance, and that's going to take all of our manufacturing activities into account. And I should say also, we're going to separate any of these variances into two more discrete categories. You will see that the direct material cost variance has two components to it: the price we paid for the materials and the quantity produced. So now we've started to look at more than just price. We're now looking at quantity. Direct labor, same thing. We're looking at, did we pay our people what we believed we would pay them? And how did we do in terms of estimating the amount of time that they would spend on each function? And then overhead gets divided into variable and fixed, with the variable being what's controllable. And all of those lead into the total cost variance for manufacturing. So as I said, we're going to have these cost variances, and in each instance, we're going to compare the actual price versus what we actually produced, and that's going to give us our actual direct materials cost. That's going to get compared against what we had projected, and then that's going to tell us what our direct materials variance is. Same thing in terms of labor. We're going to look at the actual rate times time, standard rate times time, and then the difference is going to be what the variance is. And you could have either of these factors, the rate or the time, be favorable or unfavorable, and maybe they even compensate for one another. So, this is a way in which if we, for example, were using our more experienced people that we pay more money to, but they're actually able to work more quickly and more efficiently, then we may have an unfavorable variance in one area and a favorable in the other, and they compensate for one another. Then we've got our total overhead for our factory that's going to be separated, as I said earlier, into the controllable and the fixed variances. So as I said, we've got the direct material and direct labor broken down into two more discrete categories for looking at our total variance purposes. And so now we want to look at the direct material price variance, and that's going to be just the actual price minus the standard price times the actual quantity. So this is where we're honing in on whether or not we just have a price variance, and that will give us that calculation. If the actual price per unit exceeds the standard price per unit, again, unfavorable. And so we're going to have an unfavorable variance as a debit because it will actually increase our costs I should say, versus a favorable variance which will decrease our costs, which is going to be a credit. So if you think back to your T accounts and expense items, you can picture that in terms of a T account. What increases expenses is a debit, what decreases is a credit. So here's an actual calculation of that direct materials price variance with some real numbers in it, and you can see here that we've resulted in an unfavorable variance. So we've spent more than we believed we should. Then the direct materials quantity variance can be isolated as well by doing similar to what we did with the price variance. We're subtracting the standard from the actual and then multiplying it by the standard price, and then that will isolate out the variance in our quantity, again with an unfavorable increasing costs as a debit and a favorable variance decreasing costs as a credit. And I'm going to actually stop here and go on to the next video.